Hello, everybody. My name is Magnus Brandfors. I am a financial consultant with Commonwealth Financial, utilizing Fidelity Investments as our clearing firm. And I have been a financial advisor since 1992. I primarily do discretionary portfolio management on a fee basis and generally work with a limited number of high net worth retirees. Today is June 1st of 2021, and I'm going to be discussing today three primary points. The kind of a recap of the financial markets year to date and over the last year, what things are leading or lagging in the markets. Second, we're going to be talking about something very important today, I believe, in monetary supply, or the M2 money supply in the United States. In fact, it's a discussion about the money supply globally. And thirdly, we'll be talking about what I think is the new economy, and a word that I've come up with. I'm calling it boomflation. So let's get started with a review of the financial markets coming up to June 1st here of 2020, year to date, and over the last year and 5 years. Let's talk a little bit about how the markets have performed the last couple of years. So, all right, let's put up on the screen here an index performance reporting as of May 31st of this year, 2021, and talk about some of the major takeaways. As a performance measurement tool, I generally use the S&P Target Risk Growth, Moderate, and Conservative, which is not listed here, as measurement tools. As you can see, the numbers for 2020 and 2021 on those tends to be fairly positive there for 2020. The S&P 500 last year had a particularly good year as the top 20 holdings, which are very growth oriented, really surged. What's interesting here is also that EFA, which is the international index, and the emerging markets index are not performing nearly as well as the S&P 500 in the United States. International performance has been underperforming relative to the USA now for several years, and that is something that is a bit unusual, and I would frankly expect to see that at some point here in the future that international performance equals or outpaces the US market. And here in the bond market, we can see that while it has a pretty good 3-year average, the last year has been negative. So now, what isn't really told so far in this is the difference between value stocks and growth stocks. And so I'm going to put up on the screen here a definition of what growth stocks are and what value stocks are. And you may want to pause this and take a good read of the difference between growth and value. And I'm later going to make a video that specifically discusses the difference between the two. In the first screen here now, let's look at how both large and small companies did in comparison with each other when it comes to value and growth. In 2020, large growth companies had an incredibly good year at nearly 40%. Meanwhile, the Russell 1000 Large Value Index was only up 3%, which is frankly overstated considering how poorly they had done until just before the end of the year. Now in 2021, we can see that value stocks are really outpacing large cap growth, and that now in the trailing 12 months even, value stocks are outperforming growth, both in smaller companies and larger companies. So we are maybe seeing a big shift here in the last 3-4 years have really favored growth stocks, and the more fundamentally valued, dividend paying, conservative, blue chip dividend type paying stocks now making a resurgence, this is something that may very well continue for a period of time until there becomes more parity in the total performance between the two over a longer period of time. And, so that remains to be seen. But right now, the trend seems to be indicating that there may have been a shift here. And so if we take a look at the next screen here, you can see a year-by-year comparison of the Russell 1000 value and the Russell 1000 growth. You'll see that the big shift here happened in 2017. And in my clientele and the way I managed money, I, at the time, going into 2018, started to become concerned that growth stocks were significantly overvalued and reduced my holdings in growth, only to be thwarted by the significant outperformance for almost 2 more years. Well, as a value investor, sometimes that happens. You tend to be early in or early out of investments because you are keeping an eye on the fundamentals such as price earnings ratios, dividend yields, etc. So going forward, I believe that fundamental investing and value investing has room to run and should reward my clients that are invested in more traditional value-oriented stocks. The sectors right now that are value and that are overrepresented a bit in my portfolios with my clients are going to be things like basic materials, industrial metals. It's going to be financial stocks. It's going to be heavy industry. It's going to be energy, and consumer-related goods such as retail, automotive, etc. The traditional growth in industries of technology and healthcare and various consumer products, I believe, have seen their day and become overvalued to the degree that they at least need a breather from these levels before they continue. So now let's move on to topic number 2, which is going to be the M2 money supply of the United States, and in a bigger picture, the monetary liquidity that we see worldwide today because of central bank activity, because of the COVID crisis that affected the global economy. Monetary supply. Okay, what is that? Well, let's discuss it. I'll read to you here. This is from the Federal Reserve Bank of St. Louis. M2 is a measure of the U.S. money stock that includes M1, currency and coins, held by non-bank public checkable deposits and traveler's checks, plus savings deposits including money market deposit accounts, small-time deposits under $100,000, and shares in retail money market mutual funds. Note that I didn't say mutual funds. This does not include stock, bond, whatever kind of mutual funds you may think. It is only money market mutual funds. Essentially, M2 is the measure of liquidity. How much cash and readily accessible money does the American public have? Okay, so that is the definition of it. Now, let's take it to an extreme measure. If there was literally no money supply, meaning nobody has any money, well, you can imagine what might happen with the stock market, the real estate market, consumer goods. If there's no money to buy anything, those prices surely are going to fall. Now, if there is a ton of money, in fact, if there's too much money, what's going to happen to the prices of fixed goods, consumer goods, housing, investment assets, commodities, etc.? Too much money chasing too few goods, as the definition of inflation is, prices go higher. Well, so as a measure for the stock market, an excessive amount of money is probably good for the stock market. In fact, for all of the measurements of current and future stock market performance, I personally find that the M2 money supply indicator is one of the best, along with net new employment gain. If you look at charts of these, they tend to be fairly good predictors or past indicators of what was going on with the market. So a declining money supply or dwindling money supply is usually a sign of caution or periods of economic downturn. So where does money supply stand right now? Well, the Federal Reserve, in order to accommodate the drastic measures taken during the pandemic, we've seen the M2 money supply go from $15 trillion to $22 trillion just from February of February of the year 2020, which is where the pandemic was first, really hit center stage, to April, a month or two ago. So 15 trillion to 22 trillion, an increase of virtually 50%. So where is this money coming from? It's coming from easy monetary policy. It's coming from bailouts and handouts. It's coming from people refinancing their homes and putting that cash into their bank accounts. So we're seeing this massive increase in the supply of cash. The rate of increase that we had in the last 12 months is 30%, is basically a record setter. So with record supply of readily available cash, that can generally mean that we may be facing a prolonged period of economic expansion due to the money supply. This money is going to find its way back into the economy. This $22 trillion is going to buy businesses. It is going to buy new homes. It's going to buy second homes and condos. It's going to buy vacations, new cars, cameras, sneakers, and baby food. It's going to find its way into the stock market. And it's going to find its way potentially into anything that'll have it, including Bitcoin potentially, or new investments, bad investments. So there's a ton of money out there, and it is also creating a problem with supply. So you are probably aware that the housing market has done a huge upturn here, and there is a shortage of houses out there, and there is a shortage of lumber, and there's a shortage of steel and aluminum, and so there's this supply chain disruption right now that is fueling inflation. Well, something's got to give eventually, but for the time being, and that time might be for a while, the significant amount of money supply there needs to work itself back into the system. That is probably not going to happen overnight. In fact, it's not going to happen probably over the next year. This may very well be a scenario that lasts for a few years. And I'm starting to think that this is creating a new economy, and a word that I've invented is what I think is a good description of where we are today. And that word is boomflation. The next segment, I'm going to explain what boomflation means to you and to our economy and the global economy. So, let's discuss boomflation. Boomflation. Okay, so back in the late 70s and early 80s, there was a word that was made up to describe the unusual circumstances of that economy, and that word was stagflation. Stagflation was a stagnant economy with high unemployment, with very high interest rates. It was a terrible economic predicament. So if stagflation was that description, then today boomflation appears to be low interest rates with growing employment, a strengthening economy, but inflating prices. Stagflation didn't last forever. Eventually, the economic downturn was strong enough where the Federal Reserve decided to start lowering interest rates. And as the interest rates lowered, economic activity increased, employment grew, and you created the magical economy of the 1980s. So, if stagflation eventually turned into something good, boomflation, what will it eventually do? It could eventually lead to rising rates. The question is, would it be dangerously so or not? Rising taxes. People talk a lot about rising rates and the punitive measure that that may have, but people forget that, you know, the economy can also be serviced by raising taxes on corporations and people. Boomflation could also lead to a significantly higher cost of living. And if the higher cost of living isn't met with just as rapidly growing earnings by those families, then you will wind up with an exhausted consumer. And that would lead to an economic downturn. But for now, we've got a rapidly opening economy. Everyone's outdoing themselves to, essentially become accommodative to the consumer post-pandemic. There is a starved consumer that wants to travel. They want to buy things. They want to buy a second home. They want to buy a bigger home. They want to remodel their home. They want a hot tub in the backyard. They want a fancier diamond ring. The problem is the supply chain got disrupted. So for everything that everyone wants to buy right now, there's a limited supply. You can go to places, for example, a dealership that sells, camping supplies or motorcycles or bicycles or camping gear or boats. The products are sold out, and there is not going to be any sort of near-term replacement of those goods because the supply chain currently is disrupted. What is also happening now because of that is that the used market for many goods are starting to get to reflect almost brand new prices. Makes me wonder if by the time supply comes back into the system, what will the price be of that new 2022 Ford F-150? It may be meaningfully higher than what the price was in 2019 or 2020. So going back to where we stand today, though, it's interesting that one can see so much skepticism still in the system. I follow the economic markets very closely, obviously, and it's interesting to see how many people are calling for a crash. There's going to be a crash. Well, gee whiz, we had a crash last year. Wasn't that good enough? People don't realize that lightning doesn't strike like that twice in that short of an order. Now, will there be an economic crash eventually? Well, yeah, there probably will be, because every few years there is a fairly significant downturn in the financial markets. But considering where we are right now with monetary supply, the rapidly opening economy, the starved consumer, and this healthy dose of skepticism, along with the fact that there are indeed places of fundamental value in the economic markets today that are still worth buying, I think. Things that are still relatively cheap because there's been a hangover of negativity on certain things, for example, energy, financial stocks, industrial metals and commodities, retail, travel-oriented stocks. Many of these stocks still are priced significantly lower than they have been over the last 5, 10, 15, even 20 years. So there's room to potentially grow here. So in conclusion, there are concerns about dwindling value. It will eventually catch up to the system. there is inflation going on right now that is not reflected in interest rates. There is the risk of a more punitive tax code coming for people. And the general sustainability of the consumer and the elements of irrational exuberance that we're seeing today that in essence are always punished. But for now, the tailwinds appear stronger, with the nearer term of the next 1, 2, maybe even 3 years looking unusually promising. So I appreciate you tuning in, and if you have any questions, please give me a call. And if you feel like this video might benefit somebody, by all means, please forward it to them. Thank you very much for tuning in today.